Lesson 4. Financial Planning Process. A financial planning process involves figuring out where you'd like to be, where you are, and how to go from here to there. In a more formal way, a financial planning process means the following: defining goals, assessing the current situation, identifying choices, evaluating choices, choosing, assessing the resulting situation, redefining goals, identifying new choices, evaluating new choices, choosing, assessing the resulting situation repeatedly. Personal circumstances change, and the economy changes, so your plans must be flexible enough to adapt to those changes, yet be steady enough to eventually achieve long-term goals. Determining your desired destination involves clarifying your objectives. These can include short-term goals, 1 to 2 years, medium-term goals, 2 to 10 years, and long-term aspirations that may range from practical to more idealistic. The ability to set meaningful goals is a skill that tends to improve with practice and experience. A well-known framework suggests that effective goals should be specific, measurable, achievable, relevant, and time-bound. Goals naturally evolve over time, often shifting significantly throughout your life. Despite the complexity and uncertainties of life, having a clear plan and strategy for achieving your objectives greatly enhances your chances of success. For example, imagine Sarah, a marketing professional, decides she wants to progress in her career. She starts by setting a short-term goal to earn a certification in digital marketing within the next year. This is a specific, measurable, attainable, relevant, and time-bound goal because it aligns with her career and has a clear deadline. For her intermediate goal, Sarah aims to secure a managerial position within 5 years. To work toward this, she plans to enhance her leadership skills, take on team projects, and build a strong professional network. She regularly evaluates her progress and adjusts her plan as needed. Her long-term goal, which is more ambitious, is to start her own marketing agency within the next 10 to 15 years. While this goal is less defined, it gives her a direction to move toward and inspires her to continue developing her expertise and industry connections. By breaking down her aspirations into manageable steps and adapting her plan as life changes, Sarah significantly improves her chances of achieving these milestones. Understanding your current position requires evaluating your present circumstances and the options they present. While there may be numerous possibilities, it's essential to pinpoint those most aligned with achieving your objectives. Evaluating your situation involves compiling and summarizing personal financial details to highlight key aspects of your financial life, such as your assets, liabilities, income, and expenditures. This information is organized into financial statements, including an income statement, a balance sheet, and a cash flow statement. These 3 types of statements are not only essential for personal financial planning, but are also widely used by businesses to guide their financial strategies. As Sarah works toward her career goals, she realizes the importance of understanding her financial situation. She starts by gathering information about her income, expenses, assets, and debts. Sarah creates an income statement to track her earnings and expenditures, discovering she spends a significant amount on non-essential subscriptions. Recognizing this, she decides to cut back to save more for professional development. Next, she compiles a balance sheet to outline her assets, such as savings and a small investment account, and her liabilities, including a car loan and student debt. This helps her see how much she owns versus what she owes, giving her a clearer picture of her net worth. Finally, Sarah puts together a cash flow statement to track how money moves in and out of her accounts. She notices irregular spending patterns and adjusts her budget to ensure consistent savings. With these financial statements, Sarah identifies practical steps, like creating a savings plan for her digital marketing certification and paying down her student loans faster. This structured approach helps her align her financial situation with her career goals, enabling her to make informed decisions and stay on track. To give more details, Sarah is a 28-year-old marketing professional earning $60,000 per year. She wants to evaluate her financial situation to ensure she can meet her short and long-term goals. Let's start by creating a monthly income statement for her. Since she makes $60,000 per year, we divide that by 12 to get her gross, before taxes, income of $5,000. Let's say she pays 20% in taxes, then her net, after taxes, income will be $4,000. So, on an income statement, she could write that information like this below. We're not done with the income statement, though. We still need to factor in her expenses. These are all her expenses listed below. Next, we will subtract her expenses from her net income. Doing the math, you will find that she has $550 in surplus left over. Now let's do a balance sheet for Sarah. The balance sheet will compare her assets, what helps her make money, and liabilities, money she spends or owes. This is a list of her assets and liabilities below. When we do the math, we have what's left over, or her net worth, which is $14,000. Finally, we'll do a cash flow statement. This basically keeps track of all the money that goes into her main bank account and the money that comes out from it. From the math we did earlier, we have her cash inflow as $4,000 and her cash outflow as $3,450. With that information, we can come up with the following metrics below. Here is a final analysis of Sarah's finances, with an idea of what her next steps should be in her financial planning process. Strengths. Sarah is saving consistently, has a positive net worth, and contributes to her 401k. Opportunities for improvement. She can reduce discretionary expenses, subscriptions and entertainment, by $100 per month, increasing her monthly savings to $600. She can allocate $300 from her savings each month toward her car loan to pay it off faster, saving on interest. By creating this detailed financial assessment, Sarah can confidently allocate resources toward her digital marketing certification and continue building a strong financial foundation for her long-term goals. See you in the next lesson.